The states warned about mortgage crisis years ago. More than 5 years ago, in April 2003, the attorneys general of two small states traveled to Washington with a stern warning for the nation's top bank regulator. Sitting in the spacious office of the Comptroller of the Currency, with its panoramic view of the Capitol, the attorney generals from North Carolina and Iowa said lenders were pushing increasingly risky mortgages, and their host, John D. Hawk Jr., expressed skepticism and disbelief. Roy Cooper of North Carolina and Tom Miller of Iowa headed a committee of state officials concerned about new forms of predatory lending. They urged Hawk to give states more latitude to limit extreme interest rates and fine print fees. People out there are struggling with oppressive loans, Cooper recalls saying. Hawk, a veteran banking industry lawyer appointed to head the OCC in 1998, wouldn't budge. He said no way. He said he would reinforce federal policies that hindered states from reining in lenders. The attorney generals left the tense, hour-long meeting realizing that Washington had become an enemy, a foe, in the fight against reckless real estate finance. The OCC took 50 sheriffs off the job during the time the mortgage lending industry was becoming the Wild West, Cooper says. This was but one of many instances of state posses sounding early alarms years ago about the irresponsible lending at the heart of the current financial crisis. Federal officials brushed aside their concerns. The OCC and its sister agency, the Office of Thrift Supervision, OTS, instead sided with the lenders. The beneficiaries ranged from now defunct subprime factories such as First Franklin Financial to a savings and loan owned by Lehman Brothers, the collapsed investment bank. Some states, including North Carolina and Georgia, passed laws aimed at deterring rash loans only to have federal authorities undercut them. In Iowa and other states, mortgage mills arranged to be acquired by nationally regulated banks and in the process fended off more assertive state supervision. In Ohio, the story took a different twist. State lawmakers acting at the bequest of lenders squelched an attempt by the Cleveland City Council to slow the subprime frenzy. Yes, and a frenzy it was. A number of factors contributed to the mortgage disaster and credit crunch. Interest rate cuts and unprecedented foreign capital infusions fueled thoughtless lending on Main Street and arrogant gambling on Wall Street. The trading of derivatives amplified risk it was supposed to mute. One cause, though, has been largely overlooked: the stifling of state enforcers who were looking ahead and legislatures who tried to contain the greed, yes, the greed and foolishness, extreme foolishness. They were stopped in many cases by Washington officials hostile to regulation and a financial industry adept at exploiting this ideology. The B-U-S-H administration, yes, that's still a four-letter bad word, and many banks clung to what is known as preemption. It is a legal doctrine that can be invoked in court and at the rulemaking table to assert that when federal and state authority over business conflict, the feds prevail, even if it means little or no regulation. Greed was the name of the day, name of the game. Pure greed. Fundamental disagreements. There is no question that preemption was a significant contributor to the subprime meltdown, says a former assistant attorney general in Iowa, who now works for the Center for Responsible Lending, a nonprofit in Durham, North Carolina. It pushed aside important state laws and state law enforcement that would have sent the message that there were still standards or rules in place. And it was a very big part of the message to the industry that it could regulate itself without any rules, no rules whatsoever. Yes, this is part of the reason Wall Street is tanking, or the economy has tanked. Greed, pure greed. Beyond the influence of free market theory, turf concerns have reinforced the administration's determination to exercise responsibility for as many lenders as possible and prevent state incursions. Notes: Arthur E. Wilmarth, Jr., a professor at George Washington University Law School. Almost all the funding for the OCC and OTS comes from fees paid by nationally chartered institutions. The current head of the OCC, John C. Dugan, says, "It's not our fault." Efforts in Georgia to rein in unwise lending provoked a particularly fierce federal reaction. In 2002, the state passed a law that imposed liability, assignee liability, on the mortgage finance process. Understanding the significance of all this, one of the forces that accelerated the proliferation of dangerous home loans was the Wall Street business of buying up millions and millions of mortgages, bundling them into bonds, and selling the securities to pension funds and other investors. Securitization, which grew to a $7 trillion industry, meant the lenders could pass along the risk of default to a huge universe of investors. Many of those investors, in turn, relied uncritically on reassurances from fee-collecting investment banks and ratings agencies that mortgage-backed securities were high quality. When many of the reassurances proved hollow, they really weren't high quality. The market collapsed this year. Assignee liability would radically reshape that market by making everyone involved potentially responsible when things do go bad. Investment banks that created mortgage-backed securities and investors who bought them would be liable for financial damage if mortgages turned out to be fraudulent. The financial industry opposed assignee liability, maintaining that it would cripple the market for asset-backed securities. Major ratings agencies later agreed that allowing unlimited damages would be very disruptive. The agencies threatened to stop evaluating many bonds tied to mortgages covered by the Georgia law. But some banking experts speculate that if Georgia's example had spurred more states to adopt broad assignee liability, greater caution would have prevailed in the mortgage securities market, possibly preventing the blow-ups of Lehman, Bear Stearns, and other once mighty institutions. If the Georgia law had held, it is possible that other states would have followed, and there might have been change earlier. Yes, these are part of the reasons of the mortgage meltdown and the Wall Street or Dow Jones collapse of late. Even the national debt clock has run out of numbers. The national debt is past 10 trillion now and climbing rapidly. Who's going to pay the national debt? How is it going to be paid? Is that to be put on the shoulders of the future generations to pay in a worsening economy? Anyway, these are all more signs of the end times transition days, and there are many, many signs.